Hello, everyone, and welcome back to the new Blueprint Strategy course. First of all, congratulations on completing Module 1, Strategy 101. Strategy 101 was designed to build a strong theoretical or conceptual understanding of the various powerful strategies you now have access to. So by now, you should conceptually understand the difference between technicals versus fundamentals, finite versus infinite markets. Set and forget and get alive should also be familiar trading terminology to you. You should have a basic understanding of charts. You should have basic understanding of candles, order flow, willing buyers versus willing sellers, supply versus demand, filled orders versus unfilled orders, and that every price chart consists of filled orders and unfilled orders. What we discovered is that what we see are candles in the form of filled orders. So candles represent transactions that have already taken place. Unfilled orders, on the other hand, they are invisible to us. Yet those are the orders that move future price. So our goal is to identify the areas where we're likely to find institutional unfilled orders, and we need to find and identify the areas in the price chart where institutions are willing buyers and willing sellers, so that we can align our trades with them. And this is what Module 2 will be all about. So with that out of the way, welcome to Module 2, Supply and Demand and Fundamentals for Market Setups. Module 2 is divided into 3 lessons, and each lesson will likely consist of multiple parts, that is, depending on how much time you really need for practical applications. Until today, we spent a lot of time in PowerPoint slides and we spent very little time in the charts. But from today, I want to change this. I want to switch this up. I want to spend very little time in PowerPoint slides, and instead I want to spend a lot of time, as much time as possible, in the price charts. I believe that guided interactive screen time and practical application and practice in general is the most value that I can bring to you. What I can see is that members generally that have access to a mentor are likely to show market success much faster. That is just the data that I have access to. And that makes a lot of sense as well, because as a beginner especially, you cannot audit your own belief system. You cannot audit what you're doing on your own. You cannot audit whether you're applying something the correct way or the incorrect way. I will take you by the hand, right? And well, for those of you that are following live, I'll make sure that each step of the way you understand the theory, and you don't just understand the theory, but you also know how to translate the theories into practice. Now, I can only do that if you know how to use TradeStation as well. So what I also need to do, I also need to show you how to use and how to best use TradeStation. And here I'm also going with the same stair-stepping approach. So as your trading know-how and skill advances, so will your TradeStation skill. Okay. So now you may be asking, well, what is this module all about? Simple. This module is all about the big picture of trading. In one sentence, after this module, you will know how to consistently predict major rallies and declines in the market using fundamentals, and where in terms of price you want to be a buyer or seller using supply and demand. Starting with lesson 1, supply and demand zoning. In this lesson, I will show you how to identify supply and demand imbalances, supply and demand zones. There are 4 types of formations, 2 supply and 2 demand formations. So I'll show you what those formations look like visually, and how to identify them scientifically or objectively by categorizing candles into 3 different categories. I'll also give you a mechanic process on how to identify these formations or imbalances, and also how we then wrap those lines around the imbalances to draw supply and demand zones into the chart to figure out where the institutional footprints are, to figure out where the institutional willing buyers and willing sellers are most likely to be within our beloved price charts. All right, so let's jump straight into the demand formations. As I said, there'll be 4 formations in general. There'll be 2 demand formations and there'll be 2 supply formations. The first demand formation is a so-called drop base rally, or in short, DBR. And it looks like visually, just like the name suggests, what you can see is a drop in price in the form of red candles. Then you see price basing in the form of any color of the candles. And then what you see is from a basing state or from a balanced state, you see that price is rallying higher in the form of green candles. What we'll be able to find within the base, where price was balanced before, is the origin of imbalance. Now, balance leads to an imbalance as we see price moving from basing candles to a rallying state. Okay. And where you see the yellow box, this is the demand zone or the origin of imbalance, because that's where the green candles start, right? So if you're looking for demand, we're looking for willing buyers, and hence what we need to figure out is where had the willing buyers been acting previously. And therefore, most important for us looking at this formation is the base as well as the rally. What's less important is the drop prior to price basing. Now, another formation, another demand formation is what we call rally-based rally, or in short, RBR. As the name suggests, a rally-based rally is visually seen as a rally in the chart, and then price basing or price being balanced. And from a balanced state, we see price continues to rally. So price goes from balance to imbalance. And where that happens, where price goes from balance to imbalance, that is the demand zone or the origin of imbalance. That's the origin of imbalance because that is where the relationship between the willing sellers and the willing buyers has shifted into one party being in control. And that is the willing buyers being in control, the willing sellers turning zero, and therefore we see a continued rally. Now, where that shift takes place from balance to imbalance is where the origin of imbalance is, and hence that is where the demand zone is. The most important parts for us here again is the base, and especially the rally out. Okay, what's less important for us is the rally into the zone. And you can see what the demand zones have in common. They have in common the base followed by a large rally out. Followed by a large rally out. That is the important part. Whatever happens before that, either a rally into the base or a drop into the base, that doesn't matter. That just changes the name of the demand zone. One is a drop-based rally with this visually looking like a U shape, and one just being a rally base rally with a rally prior to the base. So here again, most important, we'll be looking for green candles. Now our supply formations, they will just look very similar to our demand formations, but they're just the inverted. So, and before you had a U shape, here you have an inverted U shape. So the first supply zone is a rally-based drop. You can see price rallying, then you can see price being balanced or basing, and from the balanced state, we see price turning lower, and from balance to imbalance, where's the origin of imbalance, right where those red candles start, and therefore that's where the willing buyers in this case turned zero and the willing sellers took over. They're in control. They moved price lower, and therefore where you see the yellow box from base to the drop, that is the origin of imbalance, or that's the supply zone. Now, important here is again the base as well as the decline. That will be the most important for us. Next, we have a drop-based drop, and the drop-based drop is also, as the name suggests, it's a drop and it's a base in price, and then it's a continued drop. What's most important for us here again is the base of price and then the decline. Whatever happens before that, either a decline or a rally, that really doesn't matter too much. It's just going to be a difference between, is this a rally-based drop or is this a drop-based drop? In terms of the trading terminology, what really matters is that if we're looking for supply, is we're looking and we're trying to identify where the willing sellers really took over. And most of the time, we can see that if we look for a base followed by a large decline in price, a base followed by a large decline in price. Now, what do we do when we see those kinds of demand or supply zones? Well, one may argue that, well, what we're going to do is, if you're here, if price comes down, and then if you see price basing, what you're going to do is you're going to anticipate that this move is going to take place. Now, this is very difficult to do, right? And you may be able to do that if you apply the right fundamental set of tools. You may be able to predict the rally before it happens. You may be able to predict a demand zone to be formed before it's being formed. However, that's a lot more difficult. What's a lot easier is to let demand be formed, and after demand is formed, we're going to trade the pullback into demand, because this is where we would expect price to rise again from this area of price, because here we have more willing buyers than willing sellers, demand excess, economics 101, more willing buyers than willing sellers, and therefore we would expect price to rally. So rather than predicting this move to happen, which is also something that is possible, but it's more difficult, we need fundamentals to do that. What we're going to do at first is we're going to wait for demand to be formed, and then the plan is we're going to buy the pullback into demand. Now, where most people go wrong is when they just look at price itself without fundamentals, is they look at price and they look at price only, and they're trying to do that right here where they're predicting price to rally. They're predicting that U-shape to be formed before it's formed. Now, if we just look at price, that is very difficult to do, as we don't have fundamentals that may tell us, whether we can expect a large rally or a large decline. So by just looking at price, we have no way of knowing that there is going to be a rally out of this origin, out of this basing state. We have no way of knowing that there's going to be a rally. But after the fact that there is a rally, we can say, well, now there's a demand zone, there's an origin of imbalance. And if price comes back into this origin of imbalance, what we want to do is we want to buy. What do we do if we see a rally-based rally? Well, it's the same thing. We're not going to anticipate a rally-based rally to be formed. What we're going to do is, once we wrap our two lines around the base, around the origin of imbalance, we're going to move and extend those lines to the right. And when price comes back into the zone, we would expect price to rise again from this area, as there's more willing buyers than willing sellers. And therefore, we would place our trade parameters around the demand zone. We buy to enter and ride the wave to the upside. So again, here we will not anticipate that price is going to rally out of a basing state. What we're going to do is we're going to let price do its thing. We're going to let institutions show us the way. And once we see their footprints within the charts in form of unfilled orders, potentially, then we'll place our orders and we'll patiently wait for price to come back and then buy the demand zone. What about supply? Are we going to do anything differently when we see supply? Not really. The only difference is that rather than buying, we would be selling, right? So when we see supply, we want to be sellers. However, we're not going to anticipate this move to the downside. Rather, once that inverted U is being formed, we're going to wait for price to come back. And then that's where our action to sell comes in, as we would expect price to decline from this area. The same would apply for the drop-based drop. Once we see that a drop-based drop is being formed, once we see that price goes from a balanced state to an imbalanced state, we would then wrap our two lines around the base. We would place our set parameters around this origin of imbalance, around this supply zone. And as price comes back, we would be a seller up here within the zone, as we would expect price to decline from this area. So this is the formation summary. These are the formations that we have. We have a drop-based rally, DBR, and we have a rally-based rally, RBR. Those are demand zones, one being a U-shape, one being a rally-based rally. And what's really important for us when it comes to the demand zones is what both of them have in common is they have a base and they have a large rally out. This one as well, we have a base and we have a large rally out. And what we're going to do is we're going to buy the pullback into demand. We're going to buy the pullback into demand, as we would then expect price to rally from those areas. Likewise, for the rally-based drop, RBD, or the drop-based drop, DBD, those are both supply zones. So we have the inverted U-shape as well as a drop-based drop. What's most important to us is the base and the decline out of the base. Again, balanced state to an imbalanced state. Here again, what's most important to us is the base to the decline. And once we can see that, what's our plan? Well, we're going to wait for price to come back. We have our set parameters ready. And once price is coming back into the supply zone, we'll then trigger our sells, as we would then expect price to go lower. And the same would apply here. We would then sell the pullback, as we would then expect price to go lower. I'll do a lot of practical applications on those later on. So don't worry if you're not following 100% as of now. Within those formations that I just showed you, there are going to be different candles that make up those different parts of those formations. And as I've shown you in a previous lesson, there are thousands and hundreds of different candles. There's going to be small candles, there's going to be large candles, there's going to be candles that have crazy long wicks, and there's going to be candles that have no wicks. And for us to make sense of those candles, what we can do is we can categorize all of those hundreds of different types of candles into three different categories, three important different categories of candle types. So we'll have indecisive candles and we'll have decisive and explosive candles. Both of these types implicate a completely different scenario of what's happening in terms of what those candles may mean for us and why we want certain candles to be part of certain parts of the formation. As we know, candles, they represent transactions that already have taken place. So they represent accumulation of orders. And what you can see from the left to right, if we start right here, you can see candles that have a small body and that have relatively large wicks. Now, when we categorize our candles, what we will do is we will look at the relationship between the range and the body of our candles. Okay, so we have the entire range of our candles. Remember, that's from the low end wick to the top end wick, and we'll have the size of the body of those candles. And if we take the relationship of those two, and the body is smaller than 50% of the entire range, then what we can assume is that these are indecisive candles. Now, indecisive candles would imply that there is a balance between the willing sellers and the willing buyers, right? It would indicate that there is a balance between supply and demand, and orders are being accumulated at the moment. There's a balanced state of price at the moment. Neither the buyers nor the sellers are in control because the market is not really going anywhere. Sure, there are long wicks, there may be long wicks, but at the end of the day, if you look at the close versus the open, they're very, very close to one another. And so the scientific rule here is, again, the body should be smaller or equal to 50% of the entire range. The visual cue here, however, is the close versus the open should be close to one another, okay, visually speaking. And that is, and we'll look at that later, that is because you may have very small wicks, right? You may have no wicks at all. So the body to entire range ratio will be bigger than 50%, but the candles may be very small in context to other surrounding candles, which then implies still that is still some indecisiveness going on in the market. So you have a scientific rule now, and you have a visual cue rule. As we move further to the right, you can see that now all of a sudden, though the candles overall are the same size, the bodies are bigger, right? And now as the body becomes bigger than 50% of the entire range of that candle, then we can say, well, that is a decisive candle. That is a decisive candle because the close and the open, they're far apart from another, meaning that the willing buyers or the willing sellers pushed price quite a distance. And then we have what we call explosive candles. And explosive candles have the same properties than the decisive candles, just more extremely. And we can define them as the body being bigger than 70% of the entire range, as well as, okay, and that's an additional rule here, as well as the candle itself needs to be abnormally bigger than the previous or surrounding candles. what the decisive candles and explosive candles have in common versus the indecisive candles is that they imply an imbalance. They imply institutional activity. Explosive candles imply clear institutional activity. So the larger the candles, we spoke about this in one of the prior lessons, we could see these really large candles within our price chart. And what it means if you spot a large candle is you're basically spotting institutional activity. And the larger and the bigger and the clearer, more visually clear the candle is, the more does it imply that there may be institutional activity. So what you can already assume is that when we go back to our formations and we said that for the supply, the decline is most important, right? So there's a base, a balance state, and then there's a decline. And here as well, there's a base, a balance state, and there's a decline. And then here there's a base, a balance state, and then there's a rally. And then here there's a base, a balance state, and there's a rally. So you can already understand that, hey, the candles that we're looking at, that we want each of these parts of the formations to consist of, well, for the green part on demand here and for the red part on supply here, we want to see imbalance. We want to see institutional activity, and the better the institutional activity, well, the greater for the chances of there being unfilled orders. And so what we ideally want is, of course, you can already assume that now, is we want explosive candles to be part of this specific formation. Now, as it comes to the base, right, the base is the other thing that's important for us. We already know, well, the base, it should be maybe consisting of indecisive candles, right? They show a balance, and then we go from balance to imbalance. So let's make a little bit of a test here, if you guys understand. And what you can see is basically a candle right here. And you guys just need to show with your annotate tools whether the candle that you're seeing right now is indecisive, decisive, or explosive. Yes, this one is explosive, of course. Even though we would have to say it could also be decisive or indecisive, depending on the surrounding candles, which we don't see as of now, right? But assuming this is also abnormally bigger than the surrounding candles, then it would be for sure explosive. What about this one? Indecisive. All right. Correct. What about this one? Decisive. Yes, I would agree with that. What about this one? Let's fire them out. First come first. Indecisive. Yes. What about this one? Dennis, decisive. Yes. Continue. Just a couple more. What about this one? Indecisive again. Yes. What about this one? For sure not indecisive. Could be decisive. Could it be explosive? Decisive or explosive? I do not have the measuring tape here right now, Bash, but either way, if you say explosive here, right, this could also be explosive, especially if it's visually a lot bigger than the previous and the surrounding candles, which in this case it is. So depending on the previous candles and depending on what you see, you could say decisive or explosive. The beauty is here, regardless of what you spot here, they mean the same thing. They both indicate institutional activity, and sometimes it may not be very clear, right? And so what I don't want you to do is I don't want you to go and come with the measuring tape and measure the exact 70% or the exact 50%. I do want you to eyeball the candles, and most of the time anyways, an indecisive versus a decisive or explosive, the difference should be very clear. So next, what about this one? That's a weird looking, oddly shaped candle. Indecisive. Yes. What about this one? Explosive. Yes. And this one again is indecisive. Very well. So as we know, our formations, they consist of these three parts. We have, in the case of demand zones, a drop-based rally and a rally-based rally, DBR, RBR. And as the name suggests, there are three parts of these formations. Each part of those formations, we want certain candles to imply a certain activity in the market, either a balanced state or an imbalanced state. So what we have for all of our formations, we always have a leg in, okay, and we always have a base, and we always have a leg out. Here as well, we have a leg in, we have a base, and we have a leg out. On the supply front, we have a rally, a leg in, we have a base, and we have a leg out, a drop. On the drop-based drop, we have a drop, the leg in, we have a base, the base, and we have a drop, the leg out. So you can see the leg outs and the bases, right? The leg outs and the bases, they are what's most important to us. And so for the leg outs, what we want is, ideally, we want explosive candles. We have a leg out on a supply zone here, rally-based drop, and we have a leg out of a drop-based drop right here. And ideally, this part of the formation should be explosive, because that indicates clear institutional activity. Now, the base should consist of indecisive candles in all cases, right? In all cases, it doesn't matter. That's the easy part. It doesn't matter what formation you're looking at. The base always consists of indecisive candles. All right, that's the same thing for all of them. And the leg out should always be explosive candles. Ideally, if you can find explosive candles, then decisive candles as well, they do work. So this is a very easy set of rules that makes a lot of sense. If you want to spot institutions, how do we spot them? Well, we need to find the area where one of the two parties became zero and where there's one hell of a imbalance. How do we spot balance to imbalance? Well, what is balance? Indecisive candle. What is imbalance? Explosive candles. So what we then do is we draw some lines around the base, and that is our origin of imbalance, and those will be our demand or supply zones, depending on whether you see red candles on the leg out or green candles on the leg out. The leg in can be decisive, it can be explosive, but it doesn't matter as much as the base and especially as the leg out. If I have to put a priority on those parts of the formation, then the leg out is the most important part of the formation. The base is the second most important part of the formation. And the leg in doesn't really matter so much, but it should also be visible that there's somewhat of a leg in there. Otherwise, we can't really draw two lines around our base. So this is the zoning rule card now as it comes to the leg in. And the leg in is the price action prior to the base. That can be made up of decisive or explosive candles. doesn't matter that much, right? It could be anything. It could be a rally. It could be a decline. It could be red candles, could be green candles. Doesn't really matter that much for us. A base is where it starts to matter. We want to find a balanced state of price. So this is found between the leg in and the leg out. And it should consist of one or multiple indecisive candles. And the base that consists of our indecisive candles, that will be the zone where we'll find the unfilled orders, where we're likely to find the unfilled orders. As it comes to the leg out, we can make it very easy. The more explosive, the better. However, it doesn't necessarily have to be explosive. It can be decisive only if the candle is also abnormally bigger than the surrounding candles, and if it's followed by at least one more decisive candle. Context versus isolation. Okay. In the beginning, what I'm doing is I'm giving you a very specific set of rules that could even be practiced very scientifically, where I'm giving you the exact percentage points of the exact ratios of the body to range ratios of the candles. However, again, we're trading imperfect markets. The picture that we will find is not oftentimes as perfect as if I'm drawing the candles. So we'll have to a lot of times make sense of the context rather than over isolate candles. Hence, you have an additional visual rule on top of the scientific rule, which is, remember, the indecisive rule is the open to close to be, they need to be close by. And for the decisive and explosive candle, for the close versus open to be very far apart from one another. In this first example, if you look at the context rather than isolating those two candles that are highlighted in yellow, would you say those are indecisive candles? Would you say those are decisive candles, or explosive, or both? Indecisive? Is there someone that would argue a decisive or even an explosive state here? That makes a lot of sense, because in the context of the surrounding candles, these are very small candles. Now, it doesn't really matter if there are now long wicks to the lower end and the upper end. It's still going to be indecisive candles, because the close to the open, they're very close to one another, right? And the candle, the body is very small in general. What about this one? Would you say those are decisive or explosive in the context of things? Explosive, yes, I'd agree with that. What about these two? Explosive, decisive or indecisive? Explosive. I would say in this case, I would say they're both. They're explosive potentially, though they're rather decisive because they're not abnormally bigger than the surrounding candles, right? So they're the same size as this, the same size as this maybe. So they're by far not the biggest candle here. However, this one is for sure not decisive, right? This one is rather indecisive. It's indecisive because, yes, it doesn't have a lot of wick action that would allow us to have a scientific rule, but the candle is very small. And so the difference between this candle and this candle is minor. The only difference is, well, it has some wicks, right? But still the range it traveled overall, the range that the willing buyers or the willing sellers push price is very minor. And hence there's no one clearly in control. What we want to see with decisive and explosive candles is that there's someone clearly in control, right? Like here, or like from here to here, or from here to here. Here as well, it's the same scenario, just different colors of the candles. This one, even though in terms of the body to range ratio, this could be scientifically seen as a decisive candle. However, I would argue, well, this is the decisive candle, and this is the indecisive candle, even though the body to range ratio is exactly the same potentially, but we can see that this candle is much larger, and therefore the willing sellers here are clearly in control, versus here, they may not be that much in control. In this case, both of those candles within the base, they would be indecisive candles. And again, this candle could be decisive if you look at it scientifically, if you look at it in isolation, but if you look at it in the context where it's at and how big or small it is, how far apart or how close are the open versus the close. In this case, we have one decisive candle. This again would be an indecisive candle. Here again, very clearly indecisive candle, decisive, or even explosive. And lastly, we have one candle that's explosive, and we have one candle that is indecisive, right? It's the same size in terms of the trading range as this explosive candle, but the body to range ratio is a lot smaller, and therefore the sellers couldn't really hold price down there, as we see a big wick. And what do wicks imply? Buying pressure and selling pressure. It closed very close to where it opened, and therefore it's indecisive. So far, so good. So now moving on to identifying the imbalance. How do we go about identifying them within our price charts? So step one will be the identification of the leg out of the zone. Okay, so first from right to left, as we start at the current price, what we want to find first is those candles that indicate institutional activity. These are the candles that are very easy to spot, right? Those are the large, powerful candles that we shouldn't have hard time or trouble in searching for them. So they should be really easy to spot. So that's also the first thing that we look out for. And then we're going to look for the leg in. So we would identify the leg in of the zone. And then as we identify the leg in and the leg out, we automatically have the base, which is wrapped in between the leg in and the leg out of the zone. What we then do is we draw horizontal lines around the base, and we will extend those horizontal lines to the right of the chart because they need to be consistently visible for us as price comes back. We want to act upon those supply and demand zones. Now, there'll be certain names for those lines. There'll be a distal line and there'll be a proximal line. Now, the proximal line is always the line that's closest to current price, and the distal line is always the line that's farthest away from current price. So if we're going to look at this example right here, and we're at current price at the moment, let's say price is right here, that's current price, then if we're going to look for the supply zone, the one that's closest to current price, that's the proximal. And the one that's furthest away, that's the distal. And vice versa, in terms of demand, if you look below current price, what the line that's closest to current price, it's called the proximal. And the line that's furthest away from current price, that's called the distal. As we talk about how to draw those lines, there'll be two different versions. There's a what we call the wider version, and there's a what we call the preferred version. So for the first demand zone, the drop-based rally, we have a wider version. And as you can see, what we have is the leg out, and we have the leg in. So what's left is the base, and that's one candle, one indecisive candle. Now the wider version, as the name implies, it takes the entire range of the base, right? So we go from the proximal being at the highest wick of the basing candles and the distal being at the lowest wick of the entire formation. Okay. The difference is we have exactly the same leg in, we have exactly the same leg out, it's the same formation, we isolate the base. Now the proximal line goes slightly lower. We don't take the entire range of the basing candles. We just take the range from the upper body. So the proximal would be at the highest body of the basing candles, and the distal would be at the lowest wick of the entire formation. So you can see when it comes to the wider versus the preferred, what does not change is the distal. It stays the same, right? That's our coverage. That's our coverage line. So it's the furthest away from price. It does not change. What changes is the proximal. We either expect price to go slightly deeper into the zone, or we expect price to already potentially react from an upper area of the zone. As with unfilled orders, we never quite know where they are. They may all be sitting up here. They may all be sitting down here. We never quite know. And so what's the difference between those two? Well, for now, I just want you to understand that there are two separate versions. And there are times where we take the wider, and there are times where we take the preferred version. What you need to understand for now is not the when do we apply which one, but hey, yes, it makes sense. We can either take the entire base, right? Or we take a smaller part of the base. How we put some rules around that is, well, we take the highest wick of all the basing candles, or we take the highest body of all the basing candles when it comes to the drop base rally. Now, as it comes to the distal depends on where the lowest wick is. So the lowest wick could be part of the leg in, it could be part of the base, it could be part of the leg out. Depending on where that wick is, the lowest wick, we would always take the lowest wick of the entire formation. So we look at all three parts of the formation as we place the distal. Here we have another example. This time you have three candles within the base. Okay, so we have our leg out, we have our leg in, and now we have our base isolated. And now we wrap our proximal and distal lines around the base. And if we're going to put the proximal on the highest body of the basing candles, that's the preferred version. And if we were to put our proximal at the highest wick of this entire formation, then we would have a wider version. We would take the entire base. Now, where it becomes tricky is, depending on the wicks down here, your distal may change, right? So wherever the lowest wick is of the entire formation, we look at the leg in, the leg out, and the basing candles, we would put distal line accordingly. Now let us make an example here. Now we're looking at a weekly Apple chart. What you can see is that price currently is moving right there. So this is the current price. So what we're doing now is, what we want to do is we want to find a demand zone in the shape of a drop base rally. So what we do is we start at current price and we look below and to the left without cutting candles until we see the first candle that implies clear institutional activity. The first candle that implies, hey, there's an institution somewhere there. So the only way on this, how this candle could have been formed is if one or more institutions are willing buyers. So they are institutional willing buyers. The only question is, where is the origin of all of that, which is what we need the base for. But first things first, we need to find an explosive candle. Now we could say, well, this right here could already be an explosive candle because it's a really large candle. Yes, there are long wicks as well, so it could be decisive, but it's also a really large candle. Okay, now would we have a leg in as well, which is the second step? No, I do not yet have a leg in, right? Because again, what I have is another decisive or explosive candle. Rather an explosive candle, I would say. So again, do I find a leg in or a base? No, I don't, right? I have again a decisive candle. So if I don't find the parts of the other legs of the formation, then I continue looking, right? Because I need, our formations need to be part of three candle types. And if there's explosive versus explosive versus explosive, I am still looking for, the leg in and the base. I only have the leg out. So again, this could be a leg out. Again, it's a decisive candle. And I look again, and it's again a decisive candle. Okay, so as I look again, now, all right, all of a sudden, I have a base here. So if I have a base, I should have a leg in somewhere. Where's the leg in? Well, base, indecisive, indecisive. This is decisive. So this could be my leg in. So I have a drop, I have a base, and I have a rally. And now I have isolated the base, right? And now I could wrap my lines around the basing candles. So step one is find and identify the leg out. Now, our leg out, as we identified the leg out, it could have been here, it could have been here, here, and we ended up here because all of those were explosive candles. And then we could only find a leg in here. And so the step two find and identify the leg in. And in doing so, we now all of a sudden isolated the base. Now what's left to do is we need to wrap our lines around the basing candles. And there is where our rules come into play. So our proximal goes at the highest body of the basing candles, and the distal goes to the lowest wick of the entire formation. What's left to do is we put a beautiful box. This is a demand zone or a drop base rally. We have a proximal and we have a distal. Now that was step 3. Find and identify the basing candles. So within all of these steps, we have our rules within our rule cards, where let's talk about the step 1 for a second. What's the most important thing of the step 1? Find and identify the leg out. Well, most important thing is that we start at current price, and then we look below current price and to the left. Important, without cutting candles. So we're going to travel along the entire candles from body to wicks, and we're always going horizontally until we find an ideally explosive candle. An explosive candle, because an explosive candle will imply institutional activity. Very clearly, something is happening here. We can see, wow, so, who can push price higher? Well, it must have been a lot of willing buyers. Well, who can push prior for multiple weeks in a row? Only one or multiple institutions, and therefore we can assume that if price comes back into this demand zone drop-based rally, that there are likely unfilled orders left. There are likely still willing buyers left, because not all willing buyers were able to accumulate and fill their orders here within the base. So find and identify the leg in. What's important in terms of the leg in? Well, the leg in is not so important. Consists of decisive or explosive candle or candles. What about our step 3, the base? What ideally we want the base to be part of is that the base should consist of one or more indecisive candles. Okay, the more indecisive, the better, right? The more fight we can see within the buyers and the sellers, the better, right? So here in this case, we have an option for a wider and a preferred. Now the wider, what you can see, the wider as well as the preferred, they would be the same thing, because on the wider, I would take the highest wick of the basing candles, and in terms of the preferred, I would take the highest body of the basing candles. Now, those are more or less, if not exactly, right? This doesn't even have a wick to the upside, right? We could probably zoom in here. So you can see there's no wick whatsoever. There's maybe a tiny wick, like a few cents here. And so the wider and the preferred here in this case are the same. So in this case, we put our lines, our proximal line right here, and this would be the preferred, or the wider. It's the same thing. But for now, there'll be two versions. When to use which version doesn't really matter that much. So take a screenshot of that. Step 1, step 2, and step 3. What we do is we always put those lines, the vertical lines and the horizontal lines. And what I'm going to do as well, of course, is I'm going to show you how to navigate on your own TradeStation eventually as well. But first things first, this was the drop-based rally. There's another demand zone, and that's the rally-based rally. And for the rally-based rally, I want one of you to potentially do the practical application in just a bit after we talk about the theory real quickly here. So again, we have a wider version and a preferred version. The difference between the wider and the preferred version is where we place the proximal line. Either we're going to take the entire basing range of the candles, or we're just going to take a smaller range by using the upper body of the basing candles. And depending on which one we use, the zone would get either smaller or it would get larger. As we look at the wider version, we find a rally, leg out, and a rally as a leg in, and we isolate our base. The proximal goes at the highest wick. That's exactly the same as for the drop base rally. And the distal, that's the difference, okay? The distal goes to the lowest wick in the base, including the leg out, okay? Including the leg out. So when we look at the distal, we only look at the base and the leg out. As we looked at the drop base rally, when we placed our distal, we looked at the entire formation. So we looked at all of those candles. Here we're only looking at the base and the leg out. That's the difference. Where the proximal goes is exactly the same. Okay, so the proximal at the highest wick and the distal at the lowest wick of the base, including the leg out. Now the preferred, the distal is exactly the same, right? The distal goes to the lowest wick of the base, including the leg out. However, now as we try to make the zone smaller, we're going to use the upper body rather than the upper wick to place our proximal lines. Now, here you can see what would happen if your leg out had a longer bottom wick than the base. We would cover ourselves with that long wick of the leg out, right? See the difference here? And the difference to this is we would also cover ourselves with potentially the entire formation, where we're also looking at the leg in, as well as the base, as well as the leg out. And here we're only looking at the base versus the leg out. The leg in terms of the wicks, doesn't matter. So here's an example with 3 candles in the base again, showing the preferred version as we use the upper body of the basing candles. So the proximal line is drawn at the highest candles body of the basing candles, and the distal line is drawn at the lowest price of the base rally. So we're taking the base, including the leg out. So if, for example, the leg out had a wick that went to here, then this would put our distal line right there. However, if the leg in had a wick here, doesn't matter, right? We just look at the base and the leg out. Now let's make an example here as well. All right, who was that? This is the current price, Zina. All right, Zina would now look down to the left until you find an explosive candle. This candle is already explosive. You find another explosive candle or another part of the formation, you would go down to the left, not cutting through any candles. That's perfect. So what you find next is another explosive candle. You have a indecisive candle. And a decisive candle. So now what Zina's doing, she's wrapping the lines around the leg in. Yes. And the leg out. Okay. So What Zina basically just did is she first found the leg in, step number 1. Then she found the leg. Sorry, she found the leg out, step number 1. Then she found the leg in. In doing so, she isolated the base. In isolating the base, we can now put our proximal and our distal around those basing candles. In this case, we just have one basing candle. So the proximal can go either to the highest wick of the basing candles or to the highest body of the basing candles. Now, what Zina did is she used the wider version. She put the highest wick. She used the highest wick of the basing candles as the proximal. And of course, you used the lowest wick, including the leg in, including the leg out here for our distal right there. And then what's left to do is we put our line, we put our box. That's RBR, which is a demand zone. Now, what would we expect if we would find a demand zone that's high in quality? We would expect, as price comes back, we would expect that demand zone to hold, and we would expect willing buyers to come into play to push price higher. Now, what we can do is we can test the demand zone that Zina found, and we can just move forward a couple of months. And what you now saw is that price came into the zone, and we can see a lot of buying pressure in terms of this long wick here, a lot of buying pressure that comes into play that pushes price higher. And price at the moment is here. So already price traveled quite a bit away from the zone already. Now, what's interesting to see in this case is this is the wider version. And if we had put our line around the preferred version here, right here, the issue would have been that price never got into the proximal of the demand zone, $22 mark, right? And therefore, we would have not been in this trade because price moved higher from here. It didn't move higher from here. So again, sometimes we need the wider version. Sometimes it's better to use the preferred version. Most of all the time, it's the preferred version that we will be using, hence the name preferred. The wider version is sometimes applicable if the zone otherwise becomes too small, and if we see enough profit margin within our zones. But later, we'll put some clearer rules around that. For now, we just have to understand the unfilled orders. They are within the base, and we never quite know where they are exactly within the base. They could be within the wider version on the upper part of the basing candle. They could be within the lower part. They could be somewhere in the middle. They're hidden. We don't see them. Why we have a preferred version is because oftentimes, as we use the wider version, our zones could get very large. And with large zones, we have less profit margin. With smaller zones, we have more profit margin. However, the smaller a zone gets, the less likely it is that we'll get filled in that specific trade. So wider version versus preferred version is a trade-off between profitability and probability of getting filled, or in other words, being in the trade. right? So in this example, with the wider version, we would have been filled. With the preferred version, we would have not been filled. We would have not been in this trade. However, if we're applying our boxes to, let's say here, if let's say this is our, if this is our target, and this is our entry, and our stop is somewhere below, let's make those nice colors that we're used to, just to drive this home. Again, we'll spend a lot of time on this in the charts, as I said. So on the wider version, in this case, we have an entry. And we have a stop loss. Now, our risk is from entry to stop loss, or in other words, the size of that box. That's our risk, right? The size of that box is our risk. So our reward is how many of those boxes can we put on top of another until we go to our target. So let's check that out. So there's one. Let's make this green. There's one. There's two. There is three and a bit. So what we have in terms of risk to reward in terms of profitability is a 1, 2, 3. We have one box as a risk, and we have three boxes, collect three boxes of the same size of reward. So in this case, with the wider version, now, what about the preferred version? Well, the preferred version goes from here to here, right? And how many boxes can we now put on top of this? Well, it's one. Oops. Fill color green. Okay. And new parallel 1, 2, 3. Oh, we can already see as we collect 1 R here, what we've already collected with the preferred, or what we would have already collected with the preferred version, would have been at this stage 3 Rs. So already as we make 1 R, we make 3 Rs. Now new parallel 4, new parallel 5. So as we make 2 Rs here, we already made 5 Rs. Wow. And now we continue to the top. 6 and 7. So 3 hours versus 7 hours. Now, on the preferred version, if we're going to put this in writing now, our risk to reward or our profitability is 1 to 7, meaning for every dollar I risk, I could make $7. If I risk $100, I could make $700. If I risk $1,000, I could make $7,000. Here, if I risk $1,000, right, let's put some numbers on that. By risking 1,000 US dollars, I could gain 3,000 US dollars. Wow, that is pretty good, right? But here, we could say, well, by risking 1,000 US dollars, I could gain 7,000 US dollars. Now, that is more than double. So the wider version versus the preferred version is a trade-off between profitability and the probability of getting filled. Now, what is the problem within this demand zone right here on the preferred is price never got there. So while on paper, I could have collected 7 hours, but in reality, I never collected anything. So which one was the better scenario? The one that Sina put in, the wider version was the better one, because with the preferred one, we never would have gotten a chance to be in this trade. And so right now, it may be random to you in terms of, okay, when do I put the preferred? When do I put the wider? We can put some very objective rules around when to use which one. But in short, what it will be all about is, it will be all about, do we have enough profitability, and do we have a good probability of also getting filled? How aggressive versus how conservative do you want to act in this market? Now, of course, we could conclude here, of course, the higher the price then would go thereafter, and if we go another couple months into the future, the higher price would go thereafter, the more reward you would gain, right? So there's a couple of key takeaways here. The key takeaway here is what we're doing is we're backtesting a formation that consists of all the rules that are applicable. We have an explosive leg out, we have a clear basing candle, and we have a nice leg in as well. As we're backtesting our supply and demand zones, we can see that, hey, they're working. Yes, they will not all be working, right? And because not all of them will be working, what we need to ensure is that the ones that are working, that we're collecting a sufficient reward in relation to our risk, where the reward is always greater than the risk, at least by 1 to 2, and the higher the better. And another very important key takeaway here is, as I'm looking at the monthly time frame, the higher the time frame, the more likely it is for you to find unfilled orders. The higher the time frame, the more institutions and the more buying power or selling power, in this case buying power, it will take to move the market. And if you put this into context, how much buying power does it need to take to move the market from $22 all the way to $43, basically a double in price? Oh, it takes a lot of institutional buyers. Now, we know that, of course, that it's a lot of institutional buyers that drive price up higher here. The question is, where is the origin of the of that imbalance? Where are those willing buyers likely to be? Well, those willing buyers, they're very likely at an area where the willing sellers have become zero. Now, where did the willing sellers become zero? Well, they didn't become zero here. They are already zero here, right? They didn't become zero here. They are already zero. They didn't become zero here. They are already zero. Where did they become zero? Well, within the base. Hence, the base is so important. It's just as important as the rally up. That within the base is where, in this case, the willing sellers became zero. We go from balance. For a month, there has been a balance between the willing sellers and the willing buyers. No one was really in control. It's a small candle. Yeah, some wicks, yes, but it's a small candle. Price closed just where it opened, very close by. But then thereafter, someone was clearly in control. Institutional activity, explosive candle, lots of willing buyers, institutional willing buyers. And therefore, where can we expect the unfilled orders to be present? And again, unfilled orders move future price, right? Move future price. They are within the base. They are where the willing sellers in this case became zero. There were so many willing buyers. Not all of them could get filled at that desirable price. So they may still be willing buyers and they may still perceive this area as cheap as price comes back into this area. Let's do one more example for demand, just to show that supply and demand, as I said in the first session, it's so powerful because it's universal to all marketplaces. It's universal to all time frames. Right now, we're looking at monthly Bitcoin. So anyone can take over here and find a rally-based rally or a drop-based rally. And how you would find that is you just put two lines, start at current price with your annotate tools, go down. Once you find the leg in, mark it. Once you find the leg out, mark it, and then mark the demand and put the lines around, and then you're good to go. Let's see if one of you can manage here. That would be great. If not, I'll take over. So find one. We identify the leg out. So the leg out, we start at current price, and then we look below the current price and to the left without cutting candles until we find an ideally explosive candle. So is this candle explosive? Probably not. It's rather indecisive, especially if we look at the body to wick range ratio. It's definitely indecisive. So we look to the left, and now I'm here. I go below. Now I'm here. Now what I'm not allowed to do, just show that maybe, what I'm not allowed to do, right? If I'm going down like this, and I go now horizontally to the left, I'm now here, I go down below the wick. Now I go horizontally to the left. What I'm not allowed to do is look up and cross some of those candles. This is what you're not allowed to do. We continue to look to the left. Now we're at this candle. This here is also not an explosive candle. It's also an indecisive candle. I look below to the left. Now we finally find one explosive candle, right? So the next step
step 2 and 3, to make it short, is to find the base and to find the leg in. And now we need to find the base and we need to find the leg in. So as I go below, I have to find a base followed by a leg in. There's none, right? There's again an explosive candle. Okay, could be another leg out. Now I'm here. This could be a decisive or an explosive candle. And then I look again to the left, and now potentially I see a base, and I potentially have a leg in as well. So again, I'm not allowed to cut candles. I have to find a leg out institutional activity, and I continue looking until I also find the base as well as the leg in. So in this case, we have a leg out right here. And now, where would be the base and where would be the leg in? Well, we could say this could be the leg in. But we could also say, in the context of things, this could be the leg in. Because yes, this is an indecisive, this is a decisive candle, but the size of this decisive candle is also not much bigger than the surrounding candles, those indecisive candles. So all of that could be my base, or just that could be my base. Now you're seeing how I'm visualizing as well as I'm being scientific. Now, most of the time, especially as you operate on higher time frames, there's not really a right or wrong, and especially as it comes to the leg in part of the formation. Okay, what's really important, again, that green line here, the explosive move out here, that's what's important. Now, what we're trying to figure out is, where is that origin, right? And how much coverage to the downside in terms of the distal do we need? If you're uncertain, then take more is always better than taking too less, okay? That would be a safety first approach. However, depending on what you argue, both taking this as a leg in and taking this as a leg in, as in the context, this candle, as it's not that large, could be part of the base, that's also fine. So let's use that, for example. Now we could have a wider and a preferred version. If I have the preferred version, the proximal goes at the highest body of the basing candle. So all of these are my basing candles. And my distal goes to the lowest wick of my basing candles. Now this is my basing candle as well as the leg out. Here I have a small wick, then I go here, I have to go here, and then this is the lowest wick of my basing candles. Now I put the box around it, and what I have is, I have a RBR, and that's a demand zone. So what we want to do with that rally-based rally is, well, if price comes back, we expect unfilled orders to be present down here. There's going to be willing buyers, and therefore likely is that we would want to be starting to buy from down here. So as we now go forward, let's go forward a few months, 2 months, we can see nothing has happened yet. Now, the question that you may be asking yourself now as you're seeing new candles is, well, should I be buying or should I not be buying? Well, at the moment, you would argue, well, why should you be buying if there's no demand zone, right? And so, again, we only buy below current price, and we only buy at an area where they are likely to be willing institutional buyers. How do we know that they are likely to be willing institutional buyers? Well, where did the willing sellers become zero? Right? Did they become zero here? Maybe not so much. Did they become zero here? Maybe not so much. Did they become zero here? Maybe not so much. Did they become zero here? No, they became zero here. Very, very clearly is that they became zero here somewhere. And therefore, that is what institutions perceive as cheap. Now, technically speaking, just by looking at price. So what we would then do is we would wait for price to be in demand for us to be buyers, right? That is rule number one. We buy below current price. We sell above current price. We don't just buy. So again, let's go forward in time. We patiently wait. Again, another 2 months. And now price is going closer to our demand area. Now, what is happening? Why is price crashing down here? Well, because there's no demand in the process. So what we see when we follow price is usually moving in between higher time frame, high quality demand, and higher time frame, high quality supply areas. That is how price usually moves. That is how price flow usually goes. So price is not yet in demand. We're not yet buyers. We have not yet bought. So we're still waiting. So now what we could be doing is, well, price is coming close. So now what we could say is, well, now I'm going to place my entry. Now I'm going to place my stop loss. And so I have an entry at the proximal. And I have a stop loss at the distal. And then you could say, well, where is my target going to be? Well, maybe my target is going to be here. Now, so far, nothing happens. Let's go 2 more months. Still nothing happens, right? Price is basing, but price is not yet in demand. We again go now 3 months. And now what is happening? Price is approaching monthly demand, and we can see price is piercing into the monthly demand area. So what is now going to happen in terms of our trade? Well, we would now be filled with an entry. We would have a stop loss below. This would be the size of our risk. Now the risk could be anything, right? It could be $100. It could be $1,000. Our risk from entry to stop loss is 1. It's the size of the box. It could be anything, right? Worst case scenario now is that price potentially is stopping us out. If price is moving down lower, what would happen as a result is we would lose whatever we would risk. However, if price was to go even lower, we only lose what we risk. We don't lose much more. Now, we move to today. And what we can see is that price is moving away from this monthly demand zone. So again, what's the reward so far? Let's make this green. We have 1. We have 2. And we have 3. So far, our reward is 3. So our risk to reward today it would be 1 to 3, but maybe our risk to reward can be up to 1 to 6, right? If we were to continue to put all those boxes on top of one another, then we may achieve a 6. So far, if you risk $1,000, maybe you would make $3,000 here. Now, what are the key learnings on this chart, on the Bitcoin chart as well? Supply and demand is universal to all asset classes, to all markets, whether we look at Tesla, what we did before, whether we look at Apple, what we did before, whether we look at Bitcoin, cryptocurrency market. All markets move based on the laws of price. Now, the laws of price are based around supply and demand, willing buyers and willing sellers. It's always the same, right? It's regardless of the markets that we look at. And that's why supply and demand is so powerful. Now, another key learning is that what I'm looking at is the futures price, okay, at BTC. Now, futures trumps everything else, okay? So if you want to be trading cryptocurrencies, Bitcoin professionally, then the best way on how to approach this is by getting access to futures data, whether you do that through TradeStation or any other broker. I really don't care. We have no affiliation with TradeStation. So we have, in fact, no affiliation with any broker at the moment. So all I would want you to do is have access to futures markets from wherever you can, right? From whichever broker you have access to. And as you would, for example, now compare this demand zone to a derivative demand zone, then what you will find is, and you can test that on your own time, if you go on TradingView and you look at Bitcoin monthly demand, then what you'll find is that price seemingly never triggered a monthly demand zone, and price seemingly rallied from the middle of nowhere. So the smart observation here is, well, price didn't rally from the middle of nowhere. Price rallied from demand, right? And so that's the key takeaway here as well. Futures trumps it all. It's a central marketplace. That's what institutions have access to. That's where they trade. That's where they have to trade. So therefore, we want to look at the same data, the same price that institutions look at, and that they base their decisions on. So we already almost covered 2 hours today, and we still have our supply zones left. Next week, what we will do is we will go into our supply zones. And what I will also do next time is I'll give you a little tutorial, beginner tutorial on all these drawing functions that you need to draw in these zones to then practice on your own. But what I really want to do before I give you that tutorial is to finish the first lesson. So that first lesson will probably then have 2 parts. Part 1 today, part 2 next week. We cover supply, some practical applications on that, and then I'll give you a tutorial, and then you can go out and practice on your own and do zoning and do back testing and go back into the past and see what would have happened to the zone that you identified. Again, not all zones will be working like I'm showcasing, right? That needs to be clear. You can't be right all the time. But hey, if we're wrong, we're only losing 1. If we are right, we always should be rewarded by more than 1, we should be rewarded by at least 2 to achieve a minimum risk to reward ratio of 1:2. All right, everyone. So thanks for watching again. Thanks for participating. I'll now stop the recording, and then you can ask questions if you want. Thanks again, and ciao.